So the Fed just cut rates once again for the lowest rates in the past 3 years. Is Jerome Powell about to crash the market, or are we going higher? Let's break it down. All right, so today, October 29th, Jerome Powell and the Fed decided to cut rates again. This marks the lowest rate level in the past 3 years, and a little bit of his language was a little bit concerning. We're going to talk about that here in just a few moments. But according to CMEgroup.com already, this is where we are. The federal funds rate is currently sitting at 4 to 4.25. And the market, which was pricing in a rate cut in December, is showing some uncertainty here, with now currently at 67% of another rate cut, but a 32% of a rate pause. Now, just earlier this morning, we were sitting at cut. And I still think we do get a rate cut, but Jerome Powell used some very concerning language. And before we talk about it, one thing that he did mention is that in December 1st of 2025, quantitative tightening will basically be done with, and the Fed is going to be winding down its balance sheet, which is a bullish sign. But the alarming language that he used, some of the main comments that he said was, number one, the labor market is weakening and inflation remains somewhat elevated. Inflation right now is currently at about 3%. And oh yeah, the government's still shut down. Number two, if you're talking about available data suggests outlook has not changed. So they still want to get rates lower, right? They still want to bring this number closer to about 3.0, which is, I believe, their current target, 3 to 3.25, okay? He said, number three, job gains have significantly slowed this year. Wait until they see unemployment as unemployment ticks higher, as millions of people are not going to get their, basically their SNAP benefits this upcoming week, and the majority of government workers are working for free at the current moment. Military potentially might not get paid here in the next couple of weeks as well. So keep an eye out for that. Number four, he said tariffs are resulting in higher inflation. You could argue that. Number five, he said Fed members had strongly different views. So there were Fed members in this meeting where one of them wanted a 50 basis point cut and one of them wanted a pause. And then he talked about how another Fed rate cut in December, I don't remember if he used this exact term, far from assured, but he basically said that December's meeting does not have to have a rate cut, and the market did not like that, ladies and gentlemen. Bitcoin immediately sold off, wicked into 108. Personally, I think this is going to get filled. This video will come out after, so we'll see. I am leaning more towards seeing Bitcoin closer to that 108, 106 level, 105, 108 level, and seeing if we can slow down here. If not, expect downside pressure on BTC. Some uncertainty probably could lead us somewhere back into the high 90s. Okay? Now, S&P reacted a little bit differently after we also had, I think, Facebook and Google reporting earnings. But the S&P reacted slightly bearish, but then closed, not back at all-time highs, but did pull back up. Now, there's a couple things here to look at. Gap. Keep an eye out for these gaps to get filled before going higher, which would make sense to me. And then even something like gold. Gold aggressively turned around during FOMC meeting with Jerome Powell. I don't necessarily trade gold, but if gold can make these moves down, typically you will historically see gold moves, then BTC lags. So keep an eye out for that. Now, the biggest news of the day that Jerome said, and what the Fed is going to do, is they're going to reduce their balance sheet, which meaning we're going to go from a world of QT to QE, okay? Quantitative, and you don't got to be too smart to say that, but it sounds smart. Quantitative easing and quantitative tightening, okay? Real simple. Just go on Google. I'll do it for you. Tightening, this is where we're at right now. To control inflation, sells assets or lets them mature, decreases the money supply. So if there's less of something, right, that's going to make the dollar continue to stay around. Now, this is where we're going starting December 1st. Number one, the objective is to stimulate the economy. Number two is they're going to be buying assets. That's what the central bank's going to be do. This is the big thing here, ladies and gentlemen. The effect of the money supply. It's going to increase the money supply. You see this number right here? Let's take a sip of water for this one. This is the money supply in the US. All it has been doing is really just going higher and higher and higher. And guess what? It's going to go higher and higher and higher. Okay? The effect on interest rates lowers long-term interest rate. The moment we start to get that delay of going into that QE, everything, the housing market should slow down. Housing prices potentially, they're still going to go higher, but it should maybe pull back a little bit, okay? Because this environment encourages borrowing and spending and investing. Right now, we're in an environment where people are discouraged to borrow because rates are so high to buy a house, to take out a loan, and to invest, okay? So hopefully this video has found you in a great place. There's going to be a delay to all of this. Don't be shocked if all of these markets correct very aggressively here very soon, but cheaper money is always bullish. And what the Fed is going to do, especially going into that fifth month next year, May, where Jerome Powell is replaced and Trump gets to appoint somebody. Trump even just mentioned, I'll Google this real quick for you. Trump mentioned a couple of days ago that he already knows who the next person's going to be. Trump is soon expected to announce his Fed chair pick. They also just put a guy named Mike Selig at the CFTC, who's also very bullish on crypto and definitely XRP as well. Send this video to somebody, hit that like button, and down below in the comments, what do you think the Fed does in the December meeting? I'll see you in the next video.